U.S. natural gas stood out as the black sheep among energy markets today, reversing sharply from the $3.50 highs after a bearish EIA storage report. The data showed a 87 billion cubic feet build, notably above market expectations of 78 billion cubic feet, signaling weaker demand or stronger production than anticipated. The larger-than-expected injection quickly erased earlier gains, reminding traders that fundamentals still weigh heavily despite recent bullish momentum. Meanwhile, over the next 2 weeks, U.S. weather will stay mostly mild, with daytime highs ranging between 57 degrees Fahrenheit and 70 degrees Fahrenheit and lows in the 30s to 40s. The first week looks warmer than normal, limiting residential and commercial heating demand. Toward the end of the period, cooler overnight temperatures, especially across the Northeast, should bring a modest uptick in heating needs, though not a major surge. Overall, U.S. natural gas demand is expected to remain below seasonal averages through late October, then rise slightly as November begins. The outlook suggests total demand could hold steady around 90 to 95 billion cubic feet per day, supported mainly by LNG exports and industrial consumption rather than weather-driven heating load. Meanwhile, in the comments of my last video, some viewers asked me to revisit my analysis, noting that the EU will ban Russian gas starting in January 2026, which they view as bullish, since last year we were also oversupplied yet prices kept climbing. Well, not exactly. Partial bans don't automatically mean bullish prices. By 2026, Europe will have more LNG import capacity and diversified supply from the US and Qatar. Plus, storage levels and mild winters play a much bigger role. Last year's rally was driven by panic buying and extreme cold, not by structural shortage. Moreover, the 2026 restriction targets new contracts, not existing ones, so Russian gas can still flow under current deals. Plus, supply fundamentals and mild weather outlooks matter more now than political headlines. Nevertheless, it's important to point out that market speculators are quick to seize on news like this to push prices higher, often creating short-term rallies. However, history shows that these spikes rarely last, as underlying bearish fundamentals eventually reassert themselves and bring prices back down to more realistic levels. From a technical perspective, the bearish EIA report, combined with continued mild temperatures, is likely to push prices back toward the 50-day moving average at $3.25. A break below that level could trigger further selling. However, with winter approaching and bullish traders anticipating higher demand from rising LNG exports, the market appears to be in a buy-the-dip mode, providing strong support around the $3 level. Don't forget to comment, share this video to support the channel, and show some love. See you next time.